Alrighty, welcome everyone to Value Investing Live. I am pleased to present our guest this week, Ben Cook. Ben is a portfolio manager and member of the investment committee with BP Capital Fund Advisors LLC, which serves as the sub-advisor to the Hennessy BP Funds. He has managed the Hennessy BP Midstream Fund since 2017 and the Hennessy BP Energy Fund since 2019. For those of you out in the audience, as always, please feel free to post those questions and comments in the live chat throughout the presentation. Keep in mind, though, we are going to hold those until we get to the Q&A at the end of things, so we can go ahead and let Ben cruise through his presentation. Without anything further from me, looks like we have a couple hellos out there in the chat already, Ben, but I'll go ahead and hand things over to you. We can jump into that presentation.
Well, great. Thanks very much for the introduction, and it's good to be with you and good to be with the audience today. Looking forward to spending the next hour or so discussing our strategy and what we think differentiates us from many of our peers. I'll highlight our investment objective and our philosophy, and I'll spend some time defining the energy transition as we see it and where we see the puck headed, so to speak. I'll also spend some time discussing some recent investment examples, which I think provide some context to our investment process. So with that, we'll dive right in. Our firm was founded under the guidance of the late T. Boone Pickens, and he passed away in September of 2019. But his legacy continues with our firm and in our culture and our people and our process, and all that's unchanged since the firm's founding. Boone had a wealth of relationships in our industry that we continue to maintain today. As a firm, our singular focus is on energy, and our professionals have experience in both public and private markets. And I think a key point to make here is that our current size allows us to be nimble, providing a lot of flexibility to respond quickly as market conditions change. As far as our strategy is concerned, our energy transition strategy was launched in December of 2013, and we saw it as a way to capitalize on the significant growth enjoyed in the U.S. Energy market. And when we talk about energy, we have the ability to invest across both traditional energy and renewable energy value chains. As you may recall, Boone had an extensive experience not only with oil and gas, but later in his career with wind power and natural gas as a transportation fuel, and with a company called Clean Energy Fuels, and that continues today. And one other aspect I think that's worth mentioning is that our investable universe, which I'll define over the course of the presentation, it includes end users of energy, which we believe is a unique quality among many of our peer funds. Our portfolio, generally speaking, is concentrated in that we focus on 25 to 40 positions in a long-only manner. And in terms of our product offering, we have our strategy available in both managed accounts as well as a publicly available mutual fund. Turning to slide number 3, our investment objective, simply put, is to achieve superior risk-adjusted returns through the business cycle by capitalizing on equity mispricing. Pretty straightforward. And that objective is rooted in an investment philosophy that underpins our approach, and it's based on a number of different principles. We believe that macro and company-specific drivers that influence valuation are constantly in flux, and that often results in volatility and ultimately equity mispricing. Again, the name of the strategy is the energy transition strategy, and we believe that the energy transition is in fact underway. And interestingly, the range of expectations that, in terms of the pace of transition, that range of expectations has created a significant dispersion in equity values. And again, we think this is going to be a significant source of volatility going forward. Fundamental analysis is our primary focus, and modeling of company cash flows is central to our research activity, and that's heavily geared towards the use of relative and absolute valuation techniques. We have a disciplined portfolio risk management process, which begins with stock selection, and we place a great deal of emphasis on relative risk-reward trade-offs of portfolio candidates as well as existing constituents. And ultimately, we believe that portfolio high grading uh, constantly ensuring that your portfolio has your best ideas ultimately is the best way to achieve the end result, which is, again, maximizing returns through the cycle with a very favorable risk-adjusted return profile. Turning to slide number 4, I'll take a moment to discuss our view of the energy transition and what we think it means for investors. I'd point out that the energy transition is a broad topic, and it's worthy of its own presentation. In fact, we recently conducted another a webinar specifically on the energy transition risks and opportunities. Happy to provide that link and presentation if you'd like a copy of that. Just reach out to me. But today we distill down the essence of that presentation and key concepts into this one particular slide. And there are a lot of forecasts out there. Many are aspirational in nature. Some are realistic, and some are not realistic at all. We've combed through them all, and we think the IEA's forecast issued late last year is relatively practical and reasonable. And so it's a good starting point for discussion. I'll touch on that presentation in just a moment. But first, just to define the energy transition. What is the energy transition? Simply put, on a global basis, it's the transition away from more carbon-intensive fuels as the world pursues greenhouse gas emission reduction targets to minimize the rise in global temperatures. And if we define it more broadly, there's a variety of factors at play here that are moving that energy transition forward. And public policy and advances in technology, as well as consumer and investor preference, are all working together to drive that change in the fuel mix. But it's interesting, though. I'd point out that there are a number of different impediments to achieving full energy transition, and those challenges are made up of policy gaps between countries, inconsistent policies. We have reliability issues with certain types of renewable energies, and simple cost disadvantages all combine to make that transition very difficult. And we see any kind of limit to the pace of transition ultimately prolonging the dependence on traditional hydrocarbons. So the question becomes, what will the global energy system look like going forward, or where is the puck headed? Again, here on slide 4, we're using the IEA's energy demand forecast issued late last year. This is the World Energy Outlook 2020, and this was issued in October. In the chart to the left, what's apparent is that the IEA is forecasting energy demand growth over the next decade by about 1% on a compound annual growth rate basis. So you can see the pie there increases in size. But what's also apparent is that the market share shifts as the energy transition drivers that we'll talk about accelerate coal retirement. The coal is replaced by cleaner burning hydrocarbons in the form of natural gas and renewables. On the chart to the right, the growth in renewables and natural gas, you can see clearly outpaces that of crude oil, and coal actually diminishes. And interestingly, oil demand rises as well. But it's interesting, we see oil demand transitioning away from a transportation fuel to really one more of a need for consumable products, particularly by the petrochemical industry. The main takeaway here is that over the next decade or so, the need for energy will rise, that we will see growth, and those needs will have to be satisfied by cleaner burning energy, predominantly renewables and natural gas. So a couple of takeaways here. I think it's interesting to point out, many point to the traditional hydrocarbon energy industry as a sunsetting industry, meaning it's in the later stages of its livelihood. But the transition towards cleaner fuels doesn't happen overnight. And we include a quote here to underscore that point. This was from President Biden's Energy Secretary Jennifer Granholm during her confirmation hearing earlier this year, when she said, if we're going to get to net zero carbon emissions by 2050, we cannot do it without coal, oil, or gas being part of the mix. And that's true in the United States, but it's also particularly true in emerging countries where the cost of the transition are particularly onerous. So what does that mean for investors? I'll make a couple points here, but before I do, let's turn to slide number 5. What you're looking at here is a historical representation of our portfolio exposures by sector and by subsector. I'll describe this in detail in just a moment, but here's our take on energy investing going forward. If investing in the energy transition were as simple as mirroring that change in fuel demand mix, then portfolio construction would be pretty easy and straightforward. But we know the investment landscape today is being shaped by a variety of factors, and over time, those factors will evolve, altering the relative investment merit and risk for both traditional energy and renewable energy, and so and for some end users for that matter. So for us, flexibility is key. As part of our investment process, we have to be constantly evaluating market conditions and the drivers that change those risks and the reward opportunities, and we have to pivot accordingly. Now, at the current time, relative valuation and market conditions, in our view, strongly favor traditional energy companies, and I'll get into a couple reasons why. Look, as far as those drivers are concerned, hydrocarbon fundamentals have improved materially. When you consider the fact that broad vaccination, herd immunity, et cetera, have assisted in the process of economic reopening around the world, the financial stimulus and monetary accommodation have boosted fuel demand in economies really all over the world. And the supply situation is helping as well. We've seen supply restraint by OPEC plus producers, as well as shale producers in the U.S. have demonstrated an unprecedented level of fiscal restraint and an unwillingness to ramp spending with oil prices rising. And so the supply side is helping out as well. If we think about what's happening with renewables, massive inflows into ESG-oriented funds last year. What is a relatively small group of stocks classified as the renewable energy value chain. At least that's how we look at it. That inflow into that sector continues to provide elevated or supported elevated valuation levels for many of those companies. And we see that while the growth rates are very strong for many of these renewable companies, the valuation in most cases fairly reflect that growth. And what that means to us is these companies are going to have to perform with flawless execution. Energy end users, which I talked about being part of our end user bucket or universe of investable companies. Many of the companies in that sector are enjoying benefits of both cyclical and secular tailwinds associated with the energy transition. And some of those do look favorable, and we'll get into that later. But the other issue that I think is interesting and bears mentioning is that there's been a significant trend towards a number of institutions either divesting of traditional energy or investing only in ESG friendly energy investments, which has perpetuated, in our view, a stark valuation disparity between the two energy value chains. And so I think what's interesting here, we've never really had an environment where the outlook for different types of energy have been so opposed. And of course, these competing views of the future can't be both right. And so that disconnect really, again, presents opportunity in our view. Again, referring to that slide on chart 5, or the stacked area chart, if we think about what's happening, as I mentioned, given the backdrop of improving demand and tightened supply, it shouldn't be too much of a surprise that we're heavily weighted towards companies that will benefit for stable and rising commodity prices amidst that pandemic rebound. And that would include oil and gas companies, exploration and production, oil service, some minor degree of integrated companies. But I would also point out in that chart, and you can see this in the light green colored wedge there, our weighting towards renewables, and that weighting rose significantly in the first quarter of 2020, only to be reduced later in the year as valuation levels got, in our view, excessive. Again, we have that flexibility to pivot, but I would say recent volatility and downward pressure in some of the renewables names has presented an opportunity, and we've started to look at that more closely. But again, the main takeaway here is that we've got the flexibility to pivot to the most attractive areas in the energy market as we see them presenting themselves as the energy transition unfolds. And that for us is the key to generating return and managing risk. So let's dive into the process. The process really starts with defining our investable universe. I'll turn to slide number 6. You'll see a chart here that lays out the different sectors of the traditional hydrocarbon energy value chain and the end users, as well as the renewable class of companies that we designate as our investable universe. And the traditional energy value chain is obviously well known. The renewable energy value chain is a logical component given the energy transition we've discussed. But I'm going to take just a second to explain why we include end users of energy in our universe. Most assume that including that segment of companies is merely an attempt to hedge the portfolio, which would have a tendency to be correlated to oil. But we think about it more deeply than that. And here's how we think about it. First, obviously having a broader set of companies expands our opportunity set, and it allows us to leverage our commodity knowledge and what we've developed in terms of our familiarity with the different supply and demand fundamentals for a variety of commodities through a variety of different subsectors. And so it helps us achieve an alpha generation objective. Second, it does provide diversification of benefits. I mean, obviously the correlations to many of these subsectors are low, if not negative, with relative to oil. And so when you think about industrials, materials, even transportation sectors there, those low to negative correlations do help and provide smoothing to our return profile over time. Now, structurally, I just say we view the end user group in four subcategories. The first category would be the cost takers. As an example, I would point out airlines and trucking. These are companies that generally fit the common perception of a hedge in an energy portfolio because their profit margins tend to have an inverse relationship with energy prices. A second category would be cost pushers. These companies bear energy input costs, but they tend to enjoy some degree of margin protection. Think of companies like Sherwin-Williams and Goodyear. These companies have shown an ability to pass along higher energy costs to their customers and protect their margins, given supply and demand factors for their products. The third sector in that end user bucket would be the margin enhancers. Think here steel producers. These companies are able to pass through higher costs, and sometimes they even enjoy some margin expansion during times of heightened energy prices. Steel companies, again, are a good example. They show strong correlation to raw material and energy costs, as well as copper. Obviously, copper has many of the same broad global economic demand drivers as oil and is similarly traded in forward contracts. The fourth bucket would be relative cost beneficiaries. And here we're talking about the petrochemical industry and the aluminum producers. These companies experience a relative cost benefit in terms of changes in local energy prices here in sourcing energy here in the U.S. And we usually use the example of what's happened in China over the last several years as they've moved to really try to minimize the pollution issue associated with burning coal. The thermal coal prices have risen dramatically in China, and so as a result, we've seen a large cost gap in the industry, and that's dramatically favored North American producers of aluminum. But just to round out the investable universe discussion here, talk about renewables for a second. We view renewables as an emerging collection of technologies as opposed to say an industry with well-established legal and regulatory conventions. These companies often have their own unique set of operating, financial, and strategic drivers that determine their success and their growth rate. And so we like these drivers vary from company to company. So we like to think of the renewable space as more of a stock picker sector as opposed to an industry in the traditional sense. But we break that group down into 6 categories. Obviously, solar and wind are very rapidly growing components of the renewable value chain. Electric mobility is a significant theme in the energy transition, obviously with electric cars, buses, and eventually trucks, etc. Bioindustrials are also a component, as well as hydrogen. And we include utilities and storage would imply battery technology. So in total, our investable universe comprises roughly 400 or so companies and over $7 trillion in aggregate market cap. And that's more than adequate to build a portfolio of 25 to 40 names. So how do we go about constructing the portfolio and picking stocks? If we turn to slide number 7, our investment approach is rooted in a discipline that is scalable and repeatable. And here on this slide, we display a chart that captures the essence of that approach. It's composed of 5 distinct steps. And here we use the cycle to illustrate the fact that it is a dynamic process. It's constantly at work as we manage our portfolio. And I'll just kind of go through these steps. The first step in sourcing our ideas is to articulate a sector theme. Our goal here is to identify a narrative, and within that narrative, further identify a certain number of companies or opportunity set of companies that will benefit from those specific drivers associated with that theme. Next, once we've think of that as the sort of the first step in filtering the 400 some odd companies. So the next step really is to identify a more specific subset based on a company specific thesis. And so here we're saying, look, these companies will benefit from this theme for reason X, Y, and Z. And so it's a further qualification of that initial filtering process that allows us to narrow down a target group into ultimately what will be used as a peer group for comp valuation purposes. The third step really is to value the company and its peers. This is probably the most important part of the process. This is done, with both relative and absolute valuation approaches. We, as I said, we rely heavily on internally modeled company cash flow forecasts. We use those forecasts in comparative analysis and discounted cash flow net asset value calculations. We also use, where it's appropriate, a sum of the parts valuation process, as well as look at private market comps, recent transactions that have occurred in the marketplace. And so what we're trying to do here is identify a base case, a best case, and a risk price target for the equities. And in that process, developing a return objective based on that range of valuation. In the next step, we define this as the implementation stage. Here we size the position based on our conviction level, and that's a function again of our expected return. But it also includes an estimate of volatility and liquidity of a certain stock, and that's also viewed in the context of our existing portfolio and companies. So companies we may already have in the book. If we move to the final stage, what we characterize as monitoring and assessing, this could easily be described as an exit part of the cycle. We often will exit a name if the thesis we believe is no longer valid, meaning the company's not performing to the way we originally intended it to perform. Or 2, if we think it's prudent to harvest profits in the name, maybe it's achieved its price target. Or if we've uncovered a new opportunity with a higher conviction level and a greater expected return, we would high grade into that name. And again, so this is a dynamic process, and we continually high grade these names into or these ideas into our portfolio, and it's a process that's worked pretty well for us. The other thing I'd point out is that because we have a defined step-by-step process, if something breaks down in that process, we can go back and generally identify where that breakdown occurs if the stock's not performing, and that's important from a risk management standpoint. So let's look a little bit more closely at the investment process. Turning to slide number 8. The first step, as I mentioned, is the sourcing step, and this is a process of defining the market narrative or theme that represents a set of drivers in the marketplace. And these themes are often broad and have implications for many of the sectors we follow. And so our effort is ongoing. We have regular team meetings and continuously alter the theme or continue to develop that theme as market conditions change. But on slide 8 here, we covered just a few of these themes, and I'll hit on these real quick. We talked about coal demand facing a secular decline due to the retirement of it's coal-fired power generation capacity. Coal is being diminished in terms of its use. And in its place, natural gas and renewables are obviously growing. So we think natural gas demand fundamentals are very strong, not just from a growth perspective, organic growth, but also from a market share expansion standpoint as well. Renewable power generation, we talked about policy, cost, and preference. Obviously, it's driving the increased adoption of and penetration of renewable power. Here, again, we talk about wind and solar as well as other early stage renewable technologies. But ultimately, these are secular tailwinds for renewables, and those tailwinds are going to provide support for operating financial results for a variety of companies across the renewable value chain, including utilities. Energy exports are also a key theme here. The U.S. will continue to expand LNG export capacity over the next several years, and so we're confident we'll see growth there. And we'll continue to see growth in exports of U.S. produced crude oil and obviously petrochemicals. Our export of NGLs to the petrochemical industry abroad has been very strong. Actually, didn't really slow down very much during the pandemic. So continue to view that favorably. And then finally, renewable infrastructure. I think it's important to point out that the electrification trend that we're seeing is not just occurring with mobility, but in other areas as well. And that's going to require a significant contribution of supplies of metals and materials, whether it's copper or aluminum, or for batteries, lithium, cobalt, nickel, and other important materials. So again, these are just a couple of the themes that we see driving equity performance across our investable universe. And I would, just getting back to the process, I'd say after we define these themes and the companies that benefit from them, we then further filter the group to the most relevant beneficiaries. And at this point, I think it makes sense to use a set of examples to illustrate the process we put into place. Turning to slide number 9, the first stock I'll highlight today is a company called Comstock Resources. We've owned Comstock since May of last year and feel as though there's a number of reasons to really like Comstock. But let's start with the process, because that's really ultimately what drives our investment in Comstock. First, we mentioned the theme here behind natural gas. In our view, the demand picture for natural gas is very strong. And again, it's being driven by the shifting primary fuel mix towards a cleaner burning hydrocarbon, as well as demand pull from foreign liquefied natural gas or LNG markets. That's also providing strength. So the outlook for demand for natural gas is very good. And look, just like oil, the decline in drilling we've seen post-pandemic has also impacted supplies of natural gas, and we've continued to see inventories tighten here in the U.S. for natural gas and abroad, as a matter of fact. So pricing for us looks very strong for natural gas. So Comstock is a small cap exploration and production company that has a significant weighting toward natural gas in terms of its reserves and production. So it fits with a host of other natural gas oriented companies that sort of first pass that first filter of, if you will, of that stock selection process. Next we've talked about identifying a more specific set of companies that would make up a relative peer group or comp group, and obviously with a high weighting towards natural gas, operating and financial results are going to benefit and strengthen from what we see as those strong fundamentals. When we look a little bit deeper at the asset base and the management of the team, we think the company stands out from others. And it's particularly attractive given the valuation discount that we see relative to its peers. But just a comment on the assets. Here on slide number 9, on the top right-hand quadrant of this slide, this was taken from a recent investor relations presentation. I think this does a pretty good job at laying out the geographic footprint of Comstock's asset base in Northwest Louisiana and Northeast Texas. This is the Haynesville shale play, for those that are familiar with the shale plays here in the U.S. As you can see, the company's acreage is situated in really the heart of the Haynesville shale play. And given its geographic location, it fits well in proximity to premium price natural gas markets along the U.S. Gulf Coast. The slide in particular, I point to a couple things. It points out the expansion of the Acadian extension, the pipeline extension in fourth quarter of 21, and that'll allow Comstock to expand its access to those Gulf Coast markets, which is important because, as the slide indicates here, there's about a 10-cent per MCF pickup in volumes moving away from market centers in Carthage and Perryville down to Henry Hub and export markets there. Pricing is important, as indicated on the bottom right-hand quadrant of the chart. When you compare Comstock to its peers located in the northeastern U.S. Appalachian Basin, you can see that pricing contributes to improved differentials relative to those Appalachian peers, and that better pricing drives better full cycle returns, higher project internal rates of return, and then faster payouts, and that's all good news for investors. And I'd also point out that Comstock, obviously, they're enjoying some strength in the commodity right now, and it's interesting. Like a lot of other E&P companies, they're electing to hold or restrain spending in order to return surplus cash back to investors, and that's a clear win for equity holders. But getting back to the process, once we've established a peer group of companies, we can then look more closely at relative valuation. And so on slide number 10, I'd point out, look, in the top half of slide number 10, we highlight Comstock's historical relative valuation to its peer group on an enterprise value to estimate of forward 12-month EBITDA. Now, this chart displays, a discount in green or a premium in red to the historical average, which in this case is a 19% discount to its comp group over the last 12 months. And again, that's in the top right-hand quadrant. Now, I should point out this is, a process. We track Comstock and its respective peer group on a real-time basis. And so we know when these valuation relationships move, and when they move away from, what's considered normal, we can identify that pretty quick. And importantly, these relationships can swing widely. For instance, if you have, a dramatic change in EBITDA estimates, or if the components of enterprise value change due to capital structure changes, we're on top of that as well. So there's a lot of additional scrutiny that goes into this approach. I don't want to oversimplify it, but this is generally how it works. So here back in January of 2021, indicated by the blue arrow here, we saw an opportunity due to some underperformance relative to peers and what we saw as a historic discount to its own trading range. We saw an opportunity where really the opportunity to buy was driven by a lag in the catch-up that we saw other gas names moving higher at the beginning of that year as seasonal tax loss selling pressure abated, and Comstock was lagging. And so we saw an opportunity to add to it. And our buy is highlighted by that when we bought it there with that blue arrow. Now, I'd say on the bottom half of the chart, we do look at Comstock valuation in the context of its own historical valuation range. And here, you can see the average indicated by that white dashed line. Historically, the stock over the last 10 years has traded about 5.2 times enterprise value to forward EBITDA. And at the time that we elected to make the investment in January, that level was at about 4 times. So again, we had a complementary set of valuation metrics that to us screen favorably, and we took the opportunity to make the investment. So this leads us to the implementation stage. As I mentioned, that 5-step process. We generally had a good view of the company's operating and financial outlook, and we felt good about improving natural gas fundamentals. And the valuation opportunity screened attractive, and so we made the decision to add. And again, I can't emphasize enough. We do undertake a significant amount of diligence in addition to looking at valuation. We are familiar with management. I've known the management of this company for decades. We know the company's assets, and we pay very close attention to the public's perception of Comstock and how that evolves with the markets change. So just to round out the discussion here, as it relates to the assessment and monitoring, we continue to own the stock for the reasons we bought it. Natural gas fundamentals are continuing to improve, and we would not be making any change to our view of the stock given where it is today in the context of the broader portfolio. So that's in a nutshell. That's how we look at Comstock. I wanted to use another example to give you an idea of how it might work with end users. Turning to slide number 11, another stock we would highlight is Freeport McMoran. And we've owned Freeport since September of 2020. And again, I'll start with the process because that's ultimately what drives the investment. Again, in the source stage, our view is that metals and materials that are critical to the expansion of renewable power infrastructure and electric mobility build out will see above trend demand growth. And on the chart to the upper right on this slide, this was taken from Freeport's recent investor relations presentation. Demand growth for copper is accelerating into a relatively tight market. In fact, when you compare the current market environment to prior peaks in industry tightness back in 2011 and 2012, the industry actually had a fairly decent visibility in terms of the amount of capacity expansion and as the slide indicates here, 51 projects, which ultimately would deliver 4.6 million tons per year. Here, at the current time, we're looking at roughly 33 projects, potentially delivering 2 million tons per year. And given pandemic-related delays to project approval, which has been slow over the last 18 months, that means to us that pricing should remain elevated for a period of several years at least. In terms of the thesis for owning Freeport among global metals and mining producers, Freeport is a major producer of copper and of gold. But as a result, Freeport enjoys obviously a large operating leverage to changes in copper pricing. And again, we think it's going to track the market tightness in the copper market going forward. And just like in the Comstock example, we see tight fundamentals and pricing providing opportunity for these companies to accelerate debt reduction. And you can see that down here on the bottom right-hand corner of this slide in this chart, which indicates that net debt levels have reduced significantly since the first quarter of last year. And that should continue through the course of 2021 and into next year. And interestingly, I'd also point out that the company likely at the end of this year, early next, will resume a dividend payout, which will be a nice catalyst for equity owners as well. In terms of valuation, look, you'll see a similar analysis on the next slide. This is similar to what we did with Comstock for Freeport, but I'll just describe it briefly here because I think it's interesting. Just as with Comstock, we scrutinize Freeport valuation on a relative valuation basis to its peers, seen here in the top half of the slide. And as you can see, over the last 12 months, Freeport on average traded at 19% premium relative to its peer group. So it trades at a premium. And you might be wondering, well, gosh, it's trading rich to its peers. Why wouldn't you wait for a discount? Why buy it here? Well, I would tell you it's really a function of the rate of change that we saw with respect to copper pricing and the impact to company level cash flow generation. The outlook for copper markets was brightening considerably at the time. So a point to make here is that we're always looking for cheap stocks, but they can start out looking expensive and they can actually get cheaper very quickly if fundamentals in the marketplace are moving in the right direction. And that actually has come to fruition in the sense that we've seen the stock rise materially. Accelerated debt reduction and rising cash flow have combined to push recent valuation levels below not only peer group averages, as you can see in that top right-hand quadrant, but you can see that it's pushed valuation levels down to historical averages as well. Freeport now trades around 6 times on an enterprise value to next 12-month forward EBITDA. So in terms of implementing the trade here, we continue to like Freeport at its current position size and hold it in the portfolio in our end user category. And as a result of our, again, going back to the process, our monitoring and assessment stage, we want to continue to hold this, and we wouldn't be making any changes unless market conditions changed materially. So to wrap up here, I would just leave you with the following comments. We're optimistic about the outlook for energy, and we see it being that outlook being driven by strong cyclical and secular tailwinds. And I, just to underscore that point, I think the worst is behind us for traditional energy investors. The prior crude oil peak since 2014, we've had a price war with OPEC producers, we've had a trade war between the U.S. and China, and we've had a global pandemic. And so it's not surprising that investors are, that they've become conditioned to expect the worst from the industry. But I think you're getting the benefit of that in very favorable valuation across the traditional energy value chain today. And as I said, a cyclical rebound is unfolding. We continue to see fiscal and monetary support for economies around the world. And we also see that secular trend towards renewables growing rapidly as well. And that's going to drive that increasing primary fuel mix component. I mentioned valuations. Traditional energy companies, I think it's interesting, they're not unlike tobacco stocks in the 90s. I mean, we had fear of regulation and social concerns and demand fears. Those all kept a large component of the investor universe away from tobacco in the 90s. But if you look back at relative performance, the shift towards yield and return of cash to shareholders propelled tobacco stocks materially higher relative to the market during that decade. And so we see a similar trend unfolding with traditional energy. And again, I can't emphasize enough the significant divergence in opinion relative to when you think of what the way renewables are considered and invested in versus how traditional energy is invested in. We think that gap is going to continue to present opportunity for traditional energy investors. And volatility is going to be a mainstay. We're going to see the pace of that transition towards renewables will be uneven. Policies will change, technology will change, perception will change. Those are all reasons to believe that valuation will be a moving target, and equity prices will have a difficult time calibrating that. And that's great opportunity for us. And again, the last point I'd make is that we think we're in a great spot. Our energy strategy enjoys the ability to pivot to where we see the most attractive investment opportunity presented by that transition. So with that, I'll wrap up and turn it over for questions.
All righty. Well, Ben, thank you so much for taking us through that presentation and truly laying out the board as far as the energy strategy goes for you guys. Enlightening presentation, to say the least. It looks like we do have plenty of hellos out here in the chat so far at this point in time. Hello to all of you out there. Welcome to our international audiences as well. We do appreciate you showing up. Looks like we do have a question from one of our usual viewers here, Praveen, asking, what are some of your favorite investments in the renewable space? And I'll add on maybe potentially anything that you might be keeping your finger on the pulse of just in case something comes out of it.
Yeah, no, that's a great question. As I mentioned, there are a variety of ways to play the energy transition, and in the renewable sector, we do have, there are a handful of solar companies. We see wind and solar being the primary drivers of renewable adoption here going forward. And I'll mention a couple names. Maxion Solar is a name that has suffered a great deal of volatility. The company priced a secondary just recently, and that's weighed on the share value. But we think the cash flow growth with that company looks extremely attractive. They are a global supplier of cells to global consumers, and so where policies are very supportive, particularly in Europe and in the Far East, we see them benefiting from those trends there. I'd also say there are some companies involved in producing wind componentry. TPI Composites is a company that we like. We don't currently own it now, but we track it, and they are a manufacturer of wind blades, and obviously wind power and the build out of wind infrastructure will continue to perpetuate, I think, an increasing share of the primary fuel mix. And so they will benefit from that. Outside of wind and solar, we do like some of the materials producers. I mentioned Freeport. That's probably our favorite name to play. I'd also say that there are certain utilities that will be accelerating their pace of coal-fired power generation capacity retirement in order to move more towards renewables. And for those utilities, we see that opportunity to make investments in renewables as creating a new base of depreciable assets, which ultimately will drive earnings, cash flow, and dividend growth for utilities. And so we like NextEra Energy amongst the utilities. NextEra is in our current portfolio as well.
Awesome. Thanks for that. Moving on to our next question here from Mike, who's joining us from the UK. What are your views on the future of deep water drilling, if you've been paying attention there?
Yeah, of course. We pay attention to what's happening across the entire traditional energy value chain. And I think you're seeing pockets of success in places like Guyana and Suriname, where Exxon, Hess, Apache. You're seeing some deep water exploration in the Gulf of Mexico. We'll continue to see exploration as a component. We need to continue to replace offshore production. It's a significant component of the global supply mix. And as the industry tends to do during times of volatility, there's a risk reduction, an appetite to reduce risk in the production portfolio. And so we see international oil companies and large cap domestic E&Ps moving away from exploration. They want to focus on the manufacturing of hydrocarbons as opposed to exploration. But companies like Exxon and BP and some of the other international integrateds will continue to explore in those frontier areas, and we see that as a growing opportunity, not just for the upstream sector, but also for the oil service sector. One of the companies we own is Technip FTI, which is a company that provides subsea completion machinery and equipment once deep sea wells are completed and brought to production. So we follow very closely what's happening there. In fact, they just announced a very sizable award in Brazil this morning. So we think international exploration probably will take some time to come back, but as the coffers begin to swell and the need for growth continues, we'll see international exploration continue to be a part of the supply picture.
Understood. And continuing on to our next question here from Glenn, what do you foresee as the main risk to the energy investment thesis that y'all are running?
Well, there's all kinds of risks, and a big part of managing risk is maintaining a diversified portfolio, and that's why we're spread across both value chains to diversify into renewables and traditional energy. At this point in time, I'd break it down into a couple risks. I think from the traditional energy standpoint, I think even though oil is now trading, WTI is trading towards $74 a barrel, which by over the last 7 years, that would be a very robust price for the industry. We're not seeing the attention or the investment appetite by the institutions or generalists that traditionally have made up a significant component of the investor base in these companies. And I think it's because we continue to see significant spare capacity on the sidelines. That's OPEC spare capacity. And I think there's a general unwillingness to build significant positions in traditional energy companies until that spare capacity is utilized. And we do think that's going to happen over the next, in fact, OPEC meets this week, July 1st, that'll be tomorrow. They'll be likely announcing an increase of production, probably on the order of 500,000 barrels a day. And we fully expect them to bring oil back to the market over the next 6 months and into next year. In fact, they'll probably exhaust all of their spare capacity by mid-year next year. And I think at that time, we'll see, assuming we have a containment of of COVID and further vaccination and herd immunity, we're going to need to see production response by other producers, particularly shale producers here in the U.S. But that spare capacity and the fear that that will bring weakness to crude prices, that's a risk that we have to consider. The other risk, I think, with the renewable value chain is in policy. We've obviously, with the current administration in place, we've seen a significant support for renewable energy. We've seen an extension of tax credits for investment in renewable projects and development of those projects. And if we were to see a change in the administration, which would be less friendly to renewables and the tax credits that come with electric mobility, that could create a significant headwind for many of those renewable technologies and impair the attractive growth rates I think are priced into many of those stocks today. So we spend a lot of time thinking about how policies and market and other market drivers could affect the outlook for renewables. So we pay attention to that as well.
Absolutely. And a nice little segue as you started to get on to our next question here from Mark asking if you could comment on, and I'll ask you here, I guess, to expand on, if you will, any changes in your strategy as the increasing number of governments have started to announce the phase out of these traditional gas cars, things like that. Obviously, EU cracking down on emissions, and California here in the States, aiming for that kind of overall ban by 2030. Has that changed the strategy? Are you adapting with it? Where do you think that'll end up?
Yeah, that's a great question, and we often get that. The short answer is that we don't think the energy transition happens overnight, and that's why we include in that slide the growth rate in oil demand anticipated by the IEA over the next decade. It still continues to grow. Now, admittedly, the trend towards electric mobility, the phase out of internal combustion engine vehicles, that clearly will have an impact on oil demand. But it's important to point out, and I think I made this comment, what we do see is a transition away from oil use as a transportation fuel, more towards a fuel or an input to the production or the petrochemical industry's production of consumable goods. I mean, we wouldn't be having this conversation right now on our computers if it wasn't for the use of hydrocarbons that have made their way into plastics and materials that are used for really everything that we do. The glasses that I wear, the computer that I'm speaking through, the pen that I use to write down the questions. So it's oil will continue to be a part of our daily fabric of patterns of consumption that we see in consumable goods going forward. Now, there will be a phase out, but at this point, given the near-term fundamentals, the supply and demand fundamentals as we see it for oil, we wouldn't be altering our portfolio mix at the current time based on what we foresee as a demand diminishment for oil as a transportation fuel.
Understood. So more of a long-term shift than things kind of just cutting off at the knees.
Exactly.
For sure. And continuing on, looks like another one coming in from Praveen here. He's saying one of the challenges associated with renewables is transmission and grid enhancement, i.e. moving towards a smart electric grid. Do you have any thoughts and ideas in that area?
Yeah, we could go a long way to improve the efficiency of the transmission infrastructure in the United States and abroad. I mean, you lose a tremendous amount of power as it moves from the point of generation to consumption. We do think that the utilities will be working together to, really optimize the development of infrastructure. And what we're going to see is, whereas historically we've seen, a power generation facility and transmission lines, originate from that source of power, we're going to see a significant trend towards building transmission networks from areas that are advantaged for certain types of renewable power. So think of the majority of the wind power that's generated in the U.S. is in the central part of the country that runs north-south from sort of the panhandle of Texas up through sort of Montana. And, and also offshore. There's a significant amount of wind power that can be generated offshore. So you're going to start to see transmission networks built from those sources of wind internal to the U.S. back to where population centers are. Similarly, we expect, geographies that are advantaged for solar power, the southwestern U.S., the southern tier of states, those are all favorable provinces for development of solar power. And so we'll continue to see transmission built from those areas as well. But in terms of the transmission infrastructure, there's no question that technology can and should advance to improve the efficiency. It needs to. If electricity is going to be the primary fuel or energy that we use to power electric vehicles, we can go a long way to improving our efficiency by increasing the efficiency of those transmission lines.
Absolutely. And I'll, I guess, pose a little bit of an out there question, or I guess challenge to electrification, especially in the mobility field, that I saw earlier this week coming out. It might have been late last week, with Ford buying into some potentially grid-based technologies. Do you think with electrification potentially becoming the norm, obviously we're not there yet, but is the grid itself going to have to adapt to support all of that charging? Do you think renewables are going to take the advantage there?
Yeah, I mean, the short answer is that the grid will have to adapt. I mean, I think what you're seeing, there's also, another segment in the renewable category, which is, technology providers, which improve efficiency and the use of existing infrastructure. And that again, infrastructure connects the point of generation all the way to the end user. And so, smart metering is a technology that I think is probably in its early stages that could provide significant improvements in efficiency. And when we think about the potential for, widespread adoption of electric vehicle use, if you and I have electric cars in our house, we're going to be likely charging those during the middle of the night, and using a smart meter to reduce the amount of usage when we're not in the house, and you make use of optimal resource, whether it's generated in a distributed manner at the house via solar panels, or whether it's through the grid. Those smart meters can help us become more efficient in doing that. So yeah, and there are a handful of companies that we didn't talk about that would be primary beneficiaries of that trend. But there's no question technology will improve, the grid use will become more efficient, and the grid will evolve to become a more efficient transmitter of power.
Absolutely. Thanks for hitting on that curiosity there. Looks like we do have one last question here from Praveen, which I think will be a good one for us to go ahead and end out on here. Just in case, though, we'll keep awaiting in case anybody else wants to toss some last-minute questions at us. But question we do have here: how far away, realistically, do you think we are from hydrogen coming in as a true transportation fuel?
Yeah, that's a difficult one, and I think it's a challenge. The short answer is probably at least a decade away. And when you think about just the properties of hydrogen, what's required to move, to contain, to distribute hydrogen, we would need to alter and expand our existing, it's not just transportation network of natural gas to accommodate hydrogen transport, but to store it too. Obviously hydrogen is abundant, but in using it as a fuel, you have to contain a significant amount of the fuel in order to use it in a way that you would use gasoline or even natural gas. It's just a very difficult thing to use. And in practical terms, there's a term called embrittlement. If you're using hydrogen and you're using a steel pipeline, because the hydrogen molecule is so small, it actually can get into the actual steel structure of the pipe and create crevices and holes, and it actually embrittles the steel. So that's a problem. But it's interesting. Elon Musk in a recent quarterly call basically said that hydrogen was a pain in the butt. He used a different term, but again, it goes back to what you have to store lots of hydrogen, and you have to transport it, and it's a difficult thing to use. Now, in countries where hydrogen will be used to offset very high cost natural gas, we could see the adoption of hydrogen accelerate there. So think of places like Northwestern Europe, or let's call it even South Korea, that areas that import significant amounts of natural gas. Well, with that high price threshold, that's an easier transition to make with a higher cost use of hydrogen. It's just the economic comparison is much easier to make than it would be to make that same comparison here in the U.S., where natural gas trades at a fraction of where it does, on a global basis. But again, yeah, we're probably a decade away, and I think it's interesting. We do hear on conference calls from companies that they want to start thinking about using hydrogen. It's interesting. The end users of hydrogen ask, where are we going to get it? And the producers of the hydrogen are asking, well, who's going to buy it? So we've got some questions as to how we're going to create a market for hydrogen, a much bigger market than already exists. And so right now it's just a very small market. The potential benefit from growth in that market could be huge. The application could be huge. And so growing off a very small base into what could be a very large quantity of hydrogen use makes for an exciting investment narrative. But at this point, it's a very small market, and it'll take years to evolve.
Absolutely. Well, it looks like that is going to round out all of our questions here today, Ben. It's been an absolute pleasure. Thank you so much for taking the time to come out, giving us this great presentation, and answering these questions from our audience.
You bet. I enjoyed it. Thanks very much for having me.
Absolutely. And for those of you out in the audience, if you missed anything or you want to flip back through the slides, there is going to be a full recording of this presentation here on YouTube momentarily once we finish up, and we'll be on GuruFocus shortly as well. If you did enjoy today, make sure to like the video. Go ahead, comment your favorite part down below. That'll help us get spread around by YouTube's algorithm. And if you do want to stick around for more content, please feel free to subscribe to the channel. Without anything else, once again, Ben, it was an absolute pleasure. Thank you, thank the audience, and we wish everybody well out there moving into the future.
Thanks.